For Financial Literacy Month, PCN, in partnership with the Pennsylvania Bankers Association, presents Financial Insights.
There are 5 pillars of financial literacy: earning, saving and investing, spending, borrowing, and protecting. That's according to the PA Bankers Association. Hello, I'm Larry Casper. Today we'll concentrate on borrowing as we observe Financial Literacy Month here on PCN. Randy Black is the second vice chair of the board of directors of the PA Bankers Association. He's also president and CEO of First Citizens Community Bank. Randy, what are the usual situations that call for Pennsylvanians to borrow money from the bank?
There could be many things that an individual would need to be borrowing from the bank for, but obviously, as everybody progresses through life, life brings about change, and the important part of change is making sure that you have a banker that's there and understands what you need when that change occurs. Things that we can provide our customers with can be from a personal simple installment loan to establishing credit, if they've never had credit before, to their first car loan, to a college, going to college as a student loan for that, or their first purchase of their house, or maybe their second home. That's on the personal side. On the business side, individuals, have various needs, whether it's to start up a business, or whether it's to fund operating lines of credit, so to improve their cash flow, or just to buy raw land to build a building for construction, and equipment to put into that building, and for expansion efforts. So really, a bank is there to be your financial partner in life, basically, to help you navigate those roadblocks that exist.
And we're going to talk about the different kinds of loans you just mentioned. But first, how have attitudes about borrowing money in general changed over the years? Well,
obviously, I have some age on me, and as when I grew up, and my parents and my grandparents, it was, the attitude was, you don't borrow money if you don't need to, and it was the conservatism in the life at that point in time. But as time has changed, and in my 30 years at the bank, it's been a complete turnaround. It just seems like individuals really feel they're entitled to goods and services, and basically they're not scared of taking on debt. And if we remember back to 2008, and when the world collapsed, basically because everybody could get a car loan or whatever, that pretty much was a telltale sign that we were down that path. So what we've done is basically make sure we're doing our part in educating our customers and our public on the do's and don'ts of borrowing, when to borrow and how much to borrow. We look at our relationship with our customers when they come in for a request if they want to buy a car or buy their first home or do a startup business, that we pretty much need to be their financial partner. And they need to succeed so we succeed. We're not going to put our customers into a situation where they're going to fail, because then we fail. And so being able to partner with our customers, especially as the times have changed, and people, the old saying, use somebody else's money to make money, and that's kind of where the banking mentality is right now. The credit card industry, I think, has really kind of turned us sour a little bit, because the underwriting standards got loose there, and my daughter, when she was 16, could get a credit card, and I think that's a good thing if it's a managed process to establish credit, but it can be abused, and that's where that's where individuals can get in trouble early on in life.
What are some of the lessons you would want to impart right now for being wise with your use of a credit card?
Pretty much limit your amount that you're comfortable with, that that you can be paid, that you can pay over time. look at the terms of your credit card, basically. Understand the interest rate, understand when they start to charge the interest rate, basically. Is it after 30 days or is it in the first day that you utilize that? And look at the fees. Some of these credit cards have large annual fees, and they can be very very hard on a person when they come to renew, et cetera. So, and I'd also look at the cap of the interest rate, making sure there's at least a cap on that interest rate of 18% or something. So
cap meaning a limit in this case.
Yeah, a limit of how high that interest rate can go over time, and then how much to the limit on the card.
Randy, all the things you just mentioned a minute ago, are they contained within the fine print?
Yeah, they're contained within the fine print, which would include, the annual fee, the maximum interest rate can be charged, and obviously when the interest rate actually starts to charge, whether it's day 30 or day 1, basically. And what we try to do is make sure we sit down with our customers when they are requesting a credit card to kind of go through that, because a credit card is a really easy way to get yourself into trouble from a credit perspective, and so we want to make sure that we're doing our part in educating our customers that they know exactly what product they have.
Let's get back into loans, Randy. When the bank is considering a person for a loan, just what does the bank look at?
It's a detailed underwriting process, basically. Obviously, we will look at the financial position of the individual or business. We will get their financials. We'll look at their, and as we do their financial write-up, we're looking at their ability to repay. We want to really make sure that if they're coming in and they're requesting $100,000 over, say, a 10-year period, that they have that ability to repay that based upon the terms and conditions that are present at the time. So we'll go through underwriting process. Part of that underwriting process is just not the financial analysis of the borrower, but it's also how's that borrower performed over time. And the way that is done is basically through a credit score. And so, a credit score pretty much is a prediction of a person or business credit behavior, such as will they pay the loan back on a timely manner.
Right. Give me some examples the bank might be looking at. I mean, obviously they want to make sure you pay your bills in a timely manner.
Right. And so what happens on a credit score is basically the credit score is a 3-digit numerical number that is basically derived from a credit report. As a bank, basically, or any bank or any lender, any credit card company is required on a regular basis to report payment history to a credit agency. And so basically the credit agency will take that information, compile that, and will take your available balance, it'll take from all the sources of funds that institutions you borrow money for, and basically say, have you missed a payment? What's your payment frequency, et cetera? And all that goes into a calculation of the credit score. And so banks look at that credit score as a key indicator on past behavior of that customer, that borrower, basically, on how were they able to pay their bills on an agreed upon basis on a time manner.
Does the credit score consider how much debt you're carrying right at that moment?
It is a indirect calculation into the credit score. Yes, basically, are you over leveraged, and how much credit you have? Do you have 17 credit cards? Do you have 3 bank loans on top of those credit cards? But the major driver is, are you able to cash flow those payments on a monthly basis? Is the real issue. So to get to your question of basically how does all this impact the borrower? Basically, if an individual has, say, a low credit score, and
what would be considered low, by the way? Give us some perspective on what's good, what's poor. You said it's a 3-digit number.
Well, obviously, you can start out low as being 0. And I'll get into that a little bit because we do run into that from time to time at our institution. So, and that's an important part of this financial literacy issue. But a low credit score, we look at anything basically. It's in that 650 or less as a low credit score. Obviously, something that's in the 750 to 800 credit score is outstanding credit. Based upon that credit score, say the borrower has a low credit score in that 600 range or even in the 500 range. If the customer has the ability to cash flow that and make the payment, be able to make the payments as agreed, what will happen is, say it's a car loan, that individual will want, we'll look at that individual and say, okay, there's credit risk here involved in this the borrower's ability to repay. And so what we'll end up doing is basically it'll impact the customer's payment. He or she will have a higher payment based upon a higher interest rate because you're factoring in the additional risk based upon the underwriting and the credit score on that. It'd be just the opposite for somebody that comes in with a high credit score. The payment would be lower and the interest rate and impact the interest rate being lower, which would impact the payment being lower. So, but I do want to share an example of if you don't have a credit score, and so I go back to what I did with my two girls, and this is something I think the viewers all need to be aware of. We should do what we can to make sure that we're setting up our children to be credit savvy and to have that ability so when the time comes when they want to buy that first house or get that student loan, that they do have a credit score. And so what I did with my two girls was basically when they hit that 15, 16 time frame, I made them take out a 2-year loan, just a small amount, $2,000 to $3,000 with the bank, basically.
For nothing in particular, just for practice?
Yep, and make sure that they had a prepay, that they were making their payments, and so they were establishing a track record with their bank, and obviously that was reported back to the credit agency. So they were doing it. Then we ended up giving them a debit card, so they would then teach them, financial use of a debit card. And then as they hit college, then we provided them with a credit card with obviously a cap on the limit for that. But so when they were, when my oldest daughter got married and they were looking for the new house, she already had an established payment process. We had
because you put them on the right road when they were 15 or 16.
15 or 16, start that process, and obviously, I could do it because I was the CEO of the bank, but we do encourage as we get into the school system and educate our kids is to the importance of establishing some sort of credit behavior as soon as they can and fiscal responsible. We did have an example just 2 weeks ago in the bank. We had a young lad that I know personally came into the bank. His grandmother wants to sell his house to him. He's in his early 20s, giving him a 50% discount, and he wanted to apply for a loan. He's got a full-time job. You look at the analysis, and then all of a sudden you pull his credit, 0 credit score. So it really leaves, a financial institution and that borrower at a crossroads. You know he can make the payments. You know that he's going to pay as agreed just based upon his income, but he has no established credit.
Now, what can that young man do with a credit rating of 0?
It's a tough.
That's a fairly daunting task, I would think.
Yep.
What was the first thing that you advised him to do?
Our suggestion was basically, since he was buying it from a relative, go back to the relative and establish a payment plan for a year or 2 years, where basically his grandmother would finance the transaction, and he'd get report and have him get a credit card and start his credit side of that, and then come back, and talk to the bank at that point in time. And so, but those are things you run into day in and day out, and it's amazing what a 3-digit number or lack of a 3-digit number can impact.
It sounds like unique situations can call for different solutions.
Exactly, and that's what being a community bank and a local bank's all about. Maybe understanding those individual situations and try to work through them with the customer.
So we've been talking about credit score, Randy. Now there's something else called a credit report. On the surface, it sounds like the same thing. Any difference?
Yeah. Okay. A credit report is basically is derived from that. I think there's three major credit agencies that we report to. Three major credit agencies that we report to, basically, and what happens is, and I think I explained a little bit, that every lending institution has to report the payment frequency and the amount of debt that they have for every borrower through these credit agencies. Well, these credit agencies will take that information, compile it, and provide a credit report based upon the history and experience and the behavior of that borrower, and then a credit score is derived from the credit report.
So we've talked about trying to get a loan for a car. What about when people try to make that huge life purchase and getting more into buying a house and getting a mortgage? And the term of that loan can vary quite a bit too.
Yes, the term and interest rates can vary a lot. As a borrower, when you go to find that dream home for your purchase or whatever, you need to know what you can afford before you go looking. And so it's important to make sure that you sit down with your banker and basically spell out your financial position and know, okay, I can take on this much debt and this much monthly payment, and I'll still have money's left over basically for the essentials on a monthly basis.
How do you know when repaying a loan is within your means? Is there a simple calculation?
We use the debt to income ratio basically, and so basically, we want to make sure that we try to stay under the basically a 40% debt to income ratio basically, so they have the means by which that they can continue to build equity as they move forward.
Let's talk about another kind of loan, Randy, and this has to do with starting a business.
Yes. At First Citizens, we are a big commercial lender. We're also an ag lender, which we'll get into probably a little bit later. And as being a commercial lender, we have a lot of different industries we lend to, and some of them are startup companies, basically. And so, we will do the same underwriting process that we would look at it for a house or an individual, but at a more sophisticated level, basically. If you're looking to do a startup, we'll ask you to basically come in with a pro forma, a business plan that basically would show what the capital investment would be needed and what your expected revenue would be over a 3 to 5 year horizon. And so we will look at that pro forma, look at your credit standing, and look at what other capital you have ejected into the deal, and we will at that point in time then take that information and determine exactly how much we will be able to lend you to start up that business.
And how many small startup businesses approach you for loans?
It varies. We're a large bank covering 3 different states, so basically I can't answer that question, but we do get a lot of them, and you'll get kids, you'll get the younger generation want to come in and get into a T-shirt business or something like that. So we'll have to work.
That sounds like a classic startup small business.
Yeah, we'll have to work through that, but we're really about trying to support our small businesses in our marketplace. So.
Now, agriculture, as you know, is big business here in Pennsylvania. So if you're a farmer, does that involve yet another kind of loan?
Yes. First of all, we all know that agriculture is, based upon your guys' coverage with the agriculture community, is our #1 industry in the state of Pennsylvania. Agriculture is near and dear to me personally. I grew up on a farm. I still have some dairy cattle that I have some friends milking for me on their farms, crop out my farm. So when I took over as a CEO at the bank in 2004, we took a real interest in agriculture. In the end, it's all about making sure that we're feeding our people, and so we do a lot of agricultural lending, and most of it is real estate based, because a farmer is basically what they say, they're always land rich, cash poor. And so what we need to do is basically help that farmer And since we do have a lot of history over our life cycle on lending to farmers, we understand that the commodity pricing and the markets are cyclical, and basically that we have to be there for them in the ups and downs. And it is, through their collateral and equity that they have in their farms that we're able to do that to support them.
We have a few minutes left, Randy. Would you tell us more about the PA Bankers Association? What does your membership do?
Well, first of all, the PA Bankers Association is a member-driven organization. We currently have 120 members of banks of all sizes across the Commonwealth. The association actually supports the banking industry throughout the state of Pennsylvania by providing various educational materials and events, from a teller all the way to the executive leadership team. They advocate on behalf of the banking industry for its members, both at the state and federal level. They provide member resources. If one bank is looking for something, they have the resource by which they can make the connection. And they also provide products and services through an affiliate, basically at a discount, where they do a lot of upfront due diligence and provide that avenue for the community banks, basically, that might not have the resources to do that. They've done that for their member banks.
Now, in addition to your responsibilities at the PA Bankers Association, you're also president and CEO of the First Citizens Community Bank. Tell us about your responsibilities there on a daily basis.
Well, we are basically a $2.3 billion bank. We're in 3 different states. We have 33 locations. And so we're serving a vast geographic region in the First Citizens Community Bank's marketplace. So we have, as you can imagine, we have a lot of employees and a lot of customers. And so, I look at it as my role as basically, the chief risk officer of the organization and the chief strategy officer, basically making sure that we are performing from a financial performance perspective for our shareholders, but we are also, supporting our communities and our customers and our employees throughout the process.
We're just coming out of the COVID-19 pandemic. What do customers need from their bank during this tumultuous period?
I'd first like to start out, I hope we never experience the pandemic again. When that process started, we were in uncharted waters. Basically, our first and foremost initiative was to protect our employees, safety and health of our employees and our customers. And so, we had to rewrite the wheel, basically. And, we closed our lobby hours. We had to go through the digital side of the equation. We wanted to make sure our customers could access their money. But one of the bigger things was basically the small business customers, basically, with nobody out and about, our bread and butter customers basically had no ways to make a living. And so we ended up, working with our customers through payment deferrals, interest extensions, and we waived service charges for all our customers for 2 months, basically to help them through that process. And then the payroll protection plan program came out, and we worked around the clock, basically serving our customers to make sure that they could get, access to some of those governmental funds to keep them afloat till we work through this pandemic. Pennsylvania alone did over 258,000 PPP loans and put in that. It was equivalent to about $30.7 billion of money coming back into the small businesses of the state of Pennsylvania. So it was huge. And one thing we did learn about it is, we have a lot more respect for our customers for what they went through, and I believe the community banks really stepped up through this process to help out the small businesses in the state of Pennsylvania.
Last question, Randy. Any general advice for our viewers when they're ready to borrow money from the bank?
I guess my advice would be basically understand the borrowing and credit and the process a bank goes through. It can only benefit you as a consumer. Educate start education of financial literacy at a young age. It's very important. And get to know your local bank. Get to know your local banker. Establish that relationship. So when it comes time for a need, basically, you already have that relationship, and it can be a more streamlined process when that occurs.
Our guest has been Randy Black, second vice chair of the board of directors of the PA Bankers Association and president and CEO of First Citizens Community Bank. Thanks for joining us.
Thank you.
Financial Insights is a presentation of PCN and sponsored by the Pennsylvania Bankers Association.